Hi there, welcome to Kneppy Invests. Time to give you my 6 ASX stocks of the week for the trading week between the 12th and 16th of July. All 6 companies released some positive news to the market during the week. Most of those news announcements were trading updates. And that's the type of announcement I try to focus on mostly because those sort of news announcements, profit upgrades, trading updates, are the ones that do have the best effect on the share price in the short to medium term, even in the long term. So let's get stuck into it. And the first company I'll be looking at today is Nearmap. On July the 13th, they did release their preliminary results for financial year 21, and it did beat their guidance, which they did issue on the 4th of May. Really interesting trading when you looked at Nearmap on the 4th and 5th of May, because the share price went up significantly on the 4th of May, and then the next day some bad news came into the market and we saw the share price plunge 20%, but I'll talk about that when we look at the chart. So on the 4th of May, they guided annual contracted value, ACV, to be between 128 and 132 million, and they're right in that range. So group ACV 128 million for the year, which is significantly higher than the previous year, which was 106.4. So we are seeing some really good growth, and in particular North America growth. That's where you want to see the growth, and that has grown at 54% in the past year. Australia and New Zealand has only grown at 7%, but the fact that North America is growing at a really good rate must be good news for shareholders. And it wouldn't be much longer, maybe 2 or 3 years, before North America becomes Nearmap's biggest market. Now onto the financial history of Nearmap. And this is looking at revenue and cash flow from operations. So we see a consistent growth rate in the revenue. So this is looking at half-year results going back to the second half of financial year 2016, and we can see a fairly consistent growth rate in the revenue, and that's exactly what you want to see in a company, that they're able to do that. So sort of a linear growth, much more lumpiness when you look at the cash flow from operations, and the most recent half they did receive $19.6 million in cash flow. So really Nearmap is heading in the right direction, and you can see that with the chart when you see the share price appreciation over the last 5 years. This is the 6-year weekly chart for Nearmap going back to 2015, when I actually did hold Nearmap in my portfolio. I held it for about 2 years and then sold out for a profit in 2017, thinking I was quite smart. I'm not sure why I sold out, because during 2018 into the middle of 2019, the share price became a 7-bagger, went from 60 cents to a high of $4.20. When it got to that high of $4.20, I do think there was a little bit too much hype in this company. The valuation was a little bit too frothy, even though the company was growing. And the share price really needed to breathe, and we really needed to see the financials catch up to the growth in the share price and the valuation of the company. And the share price has halved since that high in the middle of 2019. So right now, the share price is $2.18. When you look at the weekly chart, nothing to get too excited right now. But when you focus on the daily chart and hone in what's been happening in the past year, there is possibilities of being excited about where Nearmap is heading in the short to medium term. With the daily chart for Nearmap, this goes back just prior to the COVID-19 financial panic. Share price of Nearmap got as low as just above 80 cents back then. Would have been an awesome time to buy it, in hindsight, of course. And then the share price rallied from 80 cents to a high of $3.20 towards the end of August, start of September. So during a 4 or 5 month period, the share price quadrupled. And ever since that high in the end of August at $3.20, share price has been drifting downwards quite slowly. And usually when you see that, any positive news will have troubles moving to new highs or developing into a new uptrend. We've seen that a couple of times. Looks like a new uptrend has developed, but then a bit of selling comes in. And the whole reason selling comes in is because those shareholders who bought towards August, September last year at higher prices see the opportunity to sell out. It's all about psychology. On the 5th of May, they increased guidance. Share price rose 14.5% on that day. And this sometimes I won't buy in on the day a company releases some good news like that. I'll just wait to see what happens in subsequent days. And this was an occasion where that worked, because the next day they announced a lawsuit. Some other company was suing them. The market hates uncertainty, particularly around these sort of announcements. So I hate profit downgrades. The market also hates profit downgrades. I don't hate these sort of announcements because sometimes they can be frivolous and have no effect on the company's performance in the short to even long term. But the market sees it totally different. That's why share price fell 23.3% on that day. And sometimes when you see these sort of announcements and the share price falls like this, that does lead to opportunities to buy into a company you like at lower share prices. And that's definitely, or this occasion definitely led to that opportunity. Share price got as low as about $1.60. And the share price right now is $2.18. So share price has rallied since then. When they released this increase in guidance on the 13th of July, share price rose 14.4%. And it does look, just by looking at the chart, does look like there is a potential of a new uptrend developing in Nearmap's share price. The only thing that's holding me back right now is the lack of volume that came in with this announcement, and just the fact that this is not a 6 to 9 month share price high. And the reason I focus on that is you don't have a lot of resistance there. So right now with Nearmap, there is a lot of resistance. A lot of shareholders have bought into this company over the past 6 to 9 months at higher prices, and they are resistance for this share price moving forward, unless you get a lot of volume, a lot of buyers coming in to meet all that sellers who are now wanting to sell out because the share price of Nearmap has risen in the past few days. Next company I want to talk about is Mitchell Services. This is an instance where the market completely freaked out because of an announcement the company released, very similar to Nearmap, but so this is a little bit different because another company wasn't suing Mitchell Services. In fact, it was sort of the complete opposite. So let's go back into time to February 12th. Mitchell announced the termination of a contract with this mining, or SMS Innovative Mining, because of breach of contract. So SMS were not paying Mitchell Services because they were supposed to pay him. So failure to pay invoices. And Mitchell also announced an impairment of receivables by $7.3 million. Share price decreased something like 20% on this news. For some reason, the market completely freaked out, unnecessarily in my opinion. Mitchell then served a statutory demand for $6.2 million. And then on July 13, a settlement was reached between Mitchell Services and this other company, SMS Innovative Mining. And SMS Innovative Mining are going to have to pay Mitchell Services a sum of $5 million, $3 million within 7 days, and two other payments of $1 million each by 30th September and 30th of December. And naturally enough, the market reacted positively to this, but not quite as positively as they did react to the announcement on the February 12th. So share price is still considerably lower than it was before the announcement on February 12th. So in my opinion, the market is or has reacted irrationally to this stream of news from Mitchell Services. You can see the market cap, $93 million, revenue of $203 million, and growing at a really good clip over the past 5 years, operating cash flow positive of $33 million. So even though not a very sexy sector, this is a mining services company. They drilling services. I do think this company is quite cheap for where they're heading. Onto the financial history for Mitchell Services. This is just like Nearmap, the half-yearly revenue and cash flow from operations. And we do see really good growth in revenue during this period, just like Nearmap. The only difference between Nearmap and Mitchell Services is Nearmap is a little bit more predictable. It's growing at a fairly consistent rate. This is a little bit more lumpy. You do expect to see this in what Mitchell Services do, simply because they are a drilling services company. But the fact is, you still see growth here, and operating cash flow fairly consistently growing with that too. Still a little bit more lumpy, but you tend to see that with operational cash flow in any sort of company. Won't look at the weekly chart for Mitchell. This is just the daily chart going back in just prior to the COVID-19 financial panic. I do like to see what happened during that period with all companies. Share price of Mitchell Services went as low as below 30 cents, in fact 27.5 cents. And then just like every other company, it seems like the rebound, sort of a V-shaped recovery with the share price. And just like Nearmap, the high in the share price was reached in August at around 65 cents. And we have seen share price under pressure ever since then. When this termination of a contract was announced with SMS Innovation Mining, whatever it's called, on February 12th, share price went down 20%. I do believe that was an irrational reaction from the market. I do understand uncertainty, but this was not Mitchell Services being sued by another company. This was another company that needed to pay Mitchell Services, and they were not paying. And then we saw the share price continue to drop from there. In fact, the share price went down all the way to 36.5 cents and then leveled off. And then when the settlement reached on July 13, share price rose 8% to about 46 cents. Still quite a bit lower than where we saw the share price before this termination of a contract was announced. So I do think there is a bit of opportunity here with Mitchell Services. The valuation of the company is quite low for the growth in revenue they are experiencing, and they are expected to grow even further in the next financial year. So I do think this is an opportunity. Does look like just like Nearmap, there is a potential of a new uptrend developing here. And just like Nearmap, I do think one of the problems was a lack of volume, which with this announcement of the settlement reach and all that resistance of shareholders buying at high levels during the past 6 to 9 months, particularly between August last year and February of this year. Next company I want to focus on is not a mining company, but I do look at Select Harvest, which is all about almonds. So they produce, manufacture, and sell almond-related snacks throughout the world. I do view this company as a mining company, or just like a mining company, because they are a price taker. The price that they sell almonds is determined by the market, and the price that the market determined is all about supply and demand of almonds. Select Harvest on July 13 released a market update which looked at the supply and demand issues of almonds right now. They also talked about their harvest. The harvest was completed significantly higher than 2020 by about 5,000 million tonnes. They talked about increasing demand of almonds, particularly in India, Europe and China, where they are the traditional almond markets for Select Harvest. And they've had historical monthly shipments 10 out of the last 11 months. Then they focused on the Californian drought. And they said something like, growers are reluctant to sell right now because of the Californian drought. They do know there's going to be supply issues in the future. Almonds are going to be sold at higher prices, and a lot of the growers want to wait to that time when almonds will be able to be sold at a higher price because of the ongoing Californian drought. So there's a decrease in supply, and they started talking about the Department of Agriculture in America released their objective crops estimates are down a fair bit from 2020. So it looks like almond prices are starting to increase. So they've increased 5 to 10% in the last 6 weeks because of the increasing demand and the decreasing supply. In my opinion, Select Harvest is not the long-term buy and hold sort of company. Just like a mining company, there's a right time to buy this company and a right time to sell. So it's all about the almond prices. So this chart goes all the way back to 2015. In 2015, almond prices went through the roof. So you can see Select Harvest share price went through the roof and got to a high of $13. And then almond prices fell off a cliff, probably all because there was an increase in supply because the prices of almonds went through the roof. Share price of Select Harvest went all the way down to $4, and that was in 2016. It reached $4 again in 2017. So it seems like around about $4 to $5 is a good price to buy this company. And right now, it does look like, just based off the weekly chart, we do see a potential new uptrend developing. We have seen the share price in almonds go through the roof over the last 6 or 7 weeks. In fact, it's gone from $5.50 to a current share price of $7.25. For full disclosure purposes, I do own this company for just a short to medium term hold. Next company I want to focus on is a company I know nothing about. In fact, I didn't know this company existed until they released the market update on July 12th in regards to financial year 21 sales. Inventis, ticker code IVT, market cap $12.6 million. So we'll call this company a micro cap. Revenue $9.2 million. So they do have a revenue. This is a real business. And operating cash flow negative. What little research I've done, they seem to have 2 divisions, or 2 main divisions. They have a commercial furniture division, and they have purchased different companies. And they seem to be focusing on ergonomic chairs or furniture, which I can see a bit of a growth area over the past year or so, just with a lot of people moving to some sort of home setup for their work. And they also have a technology division. I did have a quick look at some of the technology they have in that. Seems fairly interesting and diverse as well. So I do recommend having a look at some of the presentations they have released in the past year or so. Now, in regards to the unaudited financial year 21 sales, 16.8 million, and I mentioned that was up 16% on previous corresponding. Then I found another graph in one of the presentations, and they mentioned in this graph that the previous, or the financial year 20, actual numbers was 12.2 million. And when you calculate the increase on previous corresponding period, you get around 33%. So I don't know how they got 16%. So at this point in time, some of the numbers don't quite add up for me when it comes to Inventis. I'm going to do a little bit more research in this company. Inventis have been around for quite a while, so they do have revenue numbers, which I got this from either Ticker or Guru Focus. And when you look at the 4-year revenue numbers going back to 2007, you see the exact opposite to what you typically want to see in a growing company. Revenues have been dropping for the past 13, 14 years. In fact, we did see a peak in revenue in 2008 at 37.5 million, and in the most previous financial year, only had revenue of 8 million. Now, they are forecasting 16 million for this financial year, so maybe things have turned around for Inventis, and that's potentially why the market is getting excited about this company. So potentially new management have come in, they have turned things around, even though they do say turnarounds often don't turn around. That is actually a saying. Maybe this is an exception to that rule. On to one of the most unusual daily charts you'll see on the market. And why it's unusual is because even though this is a daily chart, this chart goes all the way back to 2013. And the reason why we can fit all the daily charts, all the trading into this one chart, is because during a long periods of time, this company is not traded. In fact, if we go back to 2015, it was traded on 10 days during the whole year. So that's once every 30 days, there was a trade executed with Inventis. The market did not know this company existed. And that's one of the reasons why I didn't know it existed. So if the market doesn't know, I won't know. Things have turned around in the past 18 months, and we're starting to see a little bit more interest come into this company. And one of the reasons I think the market is getting a little bit more interested is because there is that potential that management is starting to turn things around with the performance of this company. And that's why we're starting to see increasing interest, increasing volume, increasing share price as well. So this could be a high risk potential buy for anyone who believes that this is a turnaround story. Next company I want to talk about is a favourite among four-wheel drive enthusiasts, and that's ARB. Also, a popular company among fund managers. They seem to love this company to no end. And one of the side effects of the fund managers loving a company is they can drive the valuations of that company to ridiculous levels. And we're starting to see that with ARB right now. PE ratio of 41 is quite silly for this company. They did release a market update on July 14, unaudited financial year 21 sales, 623 million, up 34% on previous corresponding period. So there's some good growth, but that sort of growth will not continue in the future. There's a lot of tailwinds behind this company and other retail companies that can't continue over the next 3 or 4 years. Estimated net profit before tax between 145 and 150 million. I've talked about the PE ratio is at silly levels, about 41 or so right now. Market cap 3.6 billion. Revenue 516 million, operating cash flow last 12 months at 113 million. So even looking at the operating cash flow, which should increase this financial year, even then we are seeing a bit of frothiness when it comes to the valuation of this company. A great company, but just because a company is great doesn't mean there's good value there. ARB is a great company. And the reason I say is a great company is when you look at the growth in revenues, this is a half-yearly growth or half-yearly numbers for revenue and operating cash flow. Since 2011, we can see consistent growth. It grows from half year to half year. The only time we didn't see it grow was during the COVID-19 affected period, which was the second half of financial year 20, and that's when we just saw it down by 2 million. And then we saw the growth in revenues explode in the last half year, and it seems like that has continued for this half year. And that sort of growth is not sustainable simply because it's just been growing at too high of a rate. And it's all because of the tailwinds behind these sort of retail companies. So a lot of people out there getting a lot of money, maybe some stimulus from the government. They're maintaining their pay packets from wherever they work. But even though they can't travel, they have to spend that money somehow. So they're spending the money on home renovations, spending the money on four-wheel drive accessories. Now, in a year or 2 years, whenever the government allows us to travel overseas, where do you think all the money that people have been spending on their four-wheel drive accessories, on their home improvements, where is all that money going to go to? Well, it's going to go to funding their overseas trips. And a lot of these companies that have been experiencing tailwinds in the past year will be experiencing some headwinds. And that's more than likely see or lead to a decrease in revenues for a lot of retail companies in Australia. Over the past 10 years, even longer, we've seen ARB continually increase their revenue, continually increase their profit. And you can see that in the chart. This is the monthly chart going back to 2003. This is a sort of company that you would just buy and hold for as long as possible. In fact, a well-defined upchart or uptrend in the chart going back to that 2003 share price was around $4. We did see the share price get to a peak of $24 in 2018. Share price came up under a little bit of pressure, and during the COVID-19 financial panic, share price fell to about $10. But ever since that low in the COVID-19 financial panic, we've seen the share price in ARB go exponential. In fact, it's gone from $10 all the way to a current share price of $45. That's significantly higher than pre-COVID-19 levels. So I do believe the market is getting a little bit too excited about this company. And whenever I see the share price rise like this, an exponential rise, that does lead to some problems or potential problems in the future. I do expect the share price of ARB to go under a significant correction in the future. I don't know when that be, but I do expect it to, so I won't say halve, but potential to halve over a short period of time when the tailwinds come to completion. The last company I want to look at today is a company I've already featured in my ASX stocks of the week. That was in episode 3, Integrated Research. They released a trading update on June the 21st in regards to the second half year numbers, revenue and net profit after tax. They were expecting revenue to be between 40 and 45 million and net profit after tax to be between 4 and 7 million. Significant improvements on the previous half year, even though it's a little bit down from half year of financial year 20. They also mentioned some good momentum moving forward as well. But unfortunately, even though the market did react quite positively on this day and the next day, because the share price was in a downtrend, we did see a bit of selling coming in and actually forced the share price down even further. Then, on July 15, Integrated Research released another trading update, and they were pleased to announce that annual revenue was likely to be around the top end of their guidance range, so that's between 40 and 45 million, and annual profit after tax to be slightly high above the top end of their guidance range. So this was a profit upgrade, and in addition, net cash was going to be about 5.5 million, increase of 800,000 from this time last year. So this was a profit upgrade, and typically when a company releases a profit upgrade, the share price should increase. Did it? Let's have a look at the chart. Actually, before we get to the chart, just look at the financial history of Integrated Research. This is half-yearly numbers. Going back to 2011, we do see a good, solid upwards trend in the revenue until we get to the most recent or previous half year, where revenue just fell off a cliff from 57.7 million to 34.1 million. The one thing that's really holding me back from Integrated Research is the lack of growth in operational cash flow. In fact, you'd say it's fairly stagnant. In fact, going back 10 years ago, it was 8.83 million, and the most previous half year, it's on 11.26. One positive thing you could say, even though they did see a significant decrease in revenue in that previous half year, operating cash flow was not affected. So that's one thing holding me back, is that lack of growth in operating cash flow. With the data chart for integrated research, I'm not going all the way back to pre-COVID levels. This is going back to August, where the share price of integrated research got to a high. Seems like that's actually a common theme today. Nearmap, Mitchell Services, and now integrated research saw the share price high in August of last year, and share prices have been falling ever since then. Share price for integrated research got to a high of $4.90 and has been dropping ever since then. Current share price is $2.13. On the half-year results on 18th of February, share price went up 1% and then fell off a cliff in the next 2 trading days. And then when they released their trading update on the 21st of June, share price rose 8%. But notice the share price in previous month was significantly higher. Again, a lot of resistance. So a lot of shareholders who bought at higher prices saw the share price rise on this good news, this trading update, and saw the opportunity to sell. It's one of the reasons I like to see a good consolidation period, share price going sideways before we see some good news or trading update released to the market, because there's much less resistance for the share price to move into an uptrend. And on the 16th of July, with this trading update, share price rose 9%. I'd love to see what happens in the next few trading days. We see a bit of a share price decrease as more sellers come in, wanted to sell out because the share price has risen. That's definitely a possibility. We did see really good volume coming in on this day, on the 16th of July. That's quite positive. And the share price finished above the 50-day moving average. That will be an important thing as well. And if the share price can remain above that moving average, maybe this is the beginning of a new uptrend for integrated research. I think there's going to be a lot of resistance moving forward, so it won't be a rapid rise in the share price, but I think this could be the turning point for this company. That is all I have for this video of my ASX stocks of the week, the 12th to 16th of July. If you have any questions about the company I've featured in this video, I'd love to hear your opinions on these companies. Or if you have any questions, leave it in the comment section or answer anything you have to say. I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Talk to you later. Bye.